All right, looks like Zillow's thrown in the towel on the housing market, but I'm bored. I'm really bored. Looks like our housing market's kind of creeping along at a snail's pace. That's the way it goes, though, when we're waiting for a housing bubble to kind of burst, I suppose. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is May the 9th. Hope you're doing well. Randy Patrick here, putting the realism back in real estate. Once again, I'm bored. Like, I literally am bored of this market. I want stuff to happen now. We're moving forward with a lot of projects and things, but I really am bored about everything, which is, it shouldn't be happening, but it is. All right. This video is brought to you by our friends at Foreclosure.com. This is my affiliate link, gethousingdata.com, gethousingdata.com. If you click it, you're going to head to Foreclosure.com, and guess what? They're the #1 provider of distressed property listings in the country, so check it out. See what's going on in your backyard. The stuff we talk about, pre-foreclosures, foreclosures, tax deeds, probates, whatever, all that stuff you can find at gethousingdata.com, and you can see what's going on, I said, in your neighborhood. All right. So, interesting enough, we are still actually advertising for the distressed dealer, distressed property architect. There's still room, and I actually had like a preliminary call, which is more of a State of the Union call, to talk about the overall housing market and where it's at. So that was done on this past Thursday, and it's recorded. It's in the fulfillment platform. So this Thursday, our next call is on May 12th at 8 p.m. That'll be our first true training call. Okay, we're really going to go through all the subjects here. Who's this for? Home buyers who want to get better deals or learn how to invest, buy the primary home cheaper, investors who want to branch out and see what's going on in the marketplace, and real estate agents. A lot of real estate agents do not participate in the distressed housing market. It's going to be a great boom in the next little while, so jump in. So what are we talking about in this? We're talking about foreclosures, auctions, REOs, pre-foreclosure short sales, tax deeds. And tax deeds, a lot of the, at least in Florida right now, we're in tax certificate bidding month, so this is why it's appropriate. I'll talk about probate estate deals, taking the property subject to the mortgage, vacant land, build to rent, build to flip, on Airbnb opportunities. So all the things I'm talking about, training and teaching, it's pertinent to acquiring cheaper property today or earning income in today's housing market and the future as well too. So basically, local intel, this is what I'm getting from the feet in the street, what's going on in the marketplace here. I think it's important to talk about that. Obviously, seen some markets across the country, I've seen an increase in listings. It's May, so people are now putting their property up for sale. Why? Because summer selling season's here, and this is normally when stuff happens. I forget what day it is. It kind of changes every year, but typically there's a day in May which is the best day to sell your house, like the day where the most transaction happens, or you're guaranteed to get the most money, or something to that effect here. So you can check that out. We're seeing some longer days on market right now, DOM days on market as opposed to what it was before. Less bidding wars, but we're also seeing price reductions now. So people dropping price and then coming in at lower list prices. Mortgage rates, it's over 5%, 5.64. I saw that today. Some metros are actually losing value, so there has been some price reductions in various metros across the country. We're also seeing an increase in off-market activity. So when I talk about the feet in the street, typically stuff happens, off-market in the street where the activity takes place, and then it kind of works its way through into the retail market and then to the statistics that can capture the stuff. So right now, I'm seeing a lot of homes that are being sold for rentals or fix and flip or whatever. And, am I bullish on them? Well, I still think they're overpriced, and I don't recommend, at least what I'm seeing here. I'm not that thrilled with it, to be quite honest with you. Tough to make money, and also with maybe a pending or future correction happening, you don't want to be engaging a major fix and flip project. It's going to take you 6-9 months out, or you got to be careful on that. But that's sort of what we're seeing. We're seeing some of that. More properties become available. We're seeing price reductions. So I'll see a property that maybe last week I saw for a certain price, and this week I'm seeing it already, the $10,000 reduction. So this is at the wholesale level. So people who are doing the buy and sell assignments of contracts, they're the ones that are referred to as wholesalers. They're kind of in the middle. They're controlling the contract. They're selling the contract if they're doing it the correct way. But this is where we see they take the equity out, so they're trying to maximize what they can. And this is where we see when markets change, this is where we see it first. The wholesalers don't make as much money, and they have to reduce price quicker, or they lose the property. Simple as that. So that's where we're starting to see changes to the market, which usually is a precursor of things to come. Now, talking about Zillow, well, Zillow stock slides to a 2-year low. Wall Street keeps slashing targets amid dour housing market outlook. So this is what we're talking about here. The market is softening, full stop. Zillow plunges after company issues dire housing outlook. So, I mean, clearly, if Zillow is a publicly traded company, so you can't be negative all the time here, but they've had a pretty rough go the past 6 months back in the fall when their home purchasing business was basically shelved, and now they're obviously they're trying to get rid of those homes clearly, and other stuff is going on at Zillow, but clearly they're sort of saying the interest rates have had a big impact on the housing market and them as well too. So essentially, the mortgage rates rapidly approaching 6%. The U.S. housing market is on the verge of a vicious collapse, as discussed in these articles. It's another one for the biggest housing market linked companies to confirm just that. So ultimately, Zillow's plunged as much as 13% in late trading Tuesday after a dismal outlook stoked investor fears that rising mortgage rates will spark the next crash in the U.S. housing market. So it's not just me talking about this. It's pretty much everybody out there is talking about this now. So obviously, we see mortgage interest rates are climbing, which means your buying power decreases, which means, you can't buy that property you wanted unless sellers react to that. Will they react to it? Who knows? We're going to see that shortly. Basically, Zillow, which suffered tremendous losses of more than $500 million in esse home flipping segment, resulting in a record write-down, projected that its internet, media, and technology segment will bring in $134 million to $169 million in EBITDA in second quarter. While home sales usually pick up in the spring, Zillow's outlook indicates that soaring mortgage rates and low inventory of for-sale homes will finally slow activity. So this is kind of like, I guess the question would be, typically with our spring-summer selling season, is there enough buying power out there? Is there enough need that we'll still see home price appreciation? Or will this really sort of sour the market and we'll start to see some decreases faster than expected? That remains to be seen. So interesting stuff, though, with what's happening. But again, essentially, in hopes of preventing the stock plunge, Zillow also authorized an additional $1 billion in share buybacks, but it wasn't meant to be, and Zillow tumbled more than 13% after hours. So there goes Zillow stock prices right down there. What can you do? I mean, it's a fickle market, and I mean, Zillow was really based on a home price appreciation. Obviously the Zestimate, everyone wants to click the Zestimate and see where their houses are going, their values are going. Clearly the iBuying market really is based on appreciation. So everyone, this is Zillow having a hard time. Clearly a couple other of them have had iBuyers have had hard times, and we'll see how this fares in the next little while. I know Zillow sold a lot of its homes to hedge funds behind the scenes, as opposed to putting them on the market where everyday buyers can get at them, which is kind of a sad thing. Again, taking the market away from the home buyers once again. So not only they outpriced themselves, and they didn't even put it back on the market where people can actually get their hands on them. They sold most of them to the big hedge funds, because those guys can pick up billions of dollars right at any single time and take out the inventory. So you can see the home value index. Yeah, it's rising according to Zillow. So tough to keep buying and selling when now we're having a pullback in the buyer side of things. Clearly, you can see the homes flipped by Zillow, which is interesting. You can take a look at this sold at a profit and sold at a loss. Well, clearly, not much has been happening. Well, there's kind of an evening out or whatever, but I guess you could say a lot of losses going on, in the fall, which we saw, and not much is selling right now. So they got rid of a lot of stuff. I don't know how much inventory is left in Zillow, but you can see that a lot of orange there, or red, which is sold at loss, and that's not how home buying businesses work. Buy low, sell high, work the appreciating market. So obviously, if it's mismanaged or misread, it's going to cause problems to not just Zillow, but other iBuyers and other investors out there. So mortgage rates. This was courtesy of WolfStreet.com. Mortgage rates are shooting higher relentlessly. The daily measure of the average 30-year fixed mortgage rate by Mortgage News Daily reached 5.64% on Friday, the highest in the data going back to 2009. So this is kind of like housing crisis time of interest rates and situations going on the whole bit. Freddie Mac, there's always a little lag. They had a 5.27, which I commented on last week. So again, we're well over 5% right now, making a difference. And here's the thing. So we talk about mortgage and availability and affordability crisis, which I think is the other word now for housing bubble. But mortgage payments jumped by nearly 50%, and related expenses of property taxes and insurance also increased. This 50% jump in cost of homeownership at the current price is going to wipe out demand from big layers of potential buyers. So yes, not everybody's a top tier buyer. Not everybody can buy a $500,000 to $700,000 to $1 million property. So if the median price is up and rates are up, the buyer pool is shrinking every day. It's shrinking and shrinking. So what's going to happen? Sellers are going to have to adjust. So will the sellers keep the homes on market, play the price point reduction game just to get out while they can, still making decent money on their property? We're so high now that even if there's a reduction, a 10, 15%, correction or slight reduction, the sellers are still doing well on their property. It's not like they're losing. They're still coming out ahead. Just it's not as ahead enough like they were hoping a few months ago, right? So we'll see what happens. But again, it's one of the things that it's costing so much more. So this time last year, it's 50% more. And now, don't forget, every county, every metro location will do a reassessment on the taxes, because clearly when values spike, they go, ooh, great opportunity, and then property taxes rise and costs rise. So, there's a lot of stuff going on here. It's going to become very expensive to not only purchase a home, but to maintain, the mortgage payment, taxes, insurance, the whole bit. Everything has gone up. Everything has gone up with respect to components of owning a home right now. Utilities, repairs, deferred maintenance, materials, labor, taxes, insurance costs, the whole bit. Everything has gone up. So it really makes home ownership it makes it tough to attain, that's for sure. So of course, having said that, now we're into consumer sentiment. So Fannie Mae released this today. Consumer sentiment toward housing hits lowest level in 2 years. Affordability constraints mount as mortgage rates and home prices continue to rise. So exactly, it decreased by 4.7 points to 68.5 in April, its lowest level since May 2020, as surveyed consumers expressed heightened concerns about housing affordability and rising mortgage rates. Now, lowest level since May 2020, which is 2 years ago, but what was 2 years ago? We were in the freaking throes of COVID, so everything was locked down in the COVID pandemic. May was when we saw a real big decrease in existing home sales, just because people weren't out, people were not transacting. We were in lockdown phase. So it seems like, well, 2 years ago wasn't too long ago, but that's when we had COVID. All right. Basically, all six of the index's components decreased month over month, with a survey high 76% of consumers indicating that they believe it's a bad time to buy a house, up from 73% last month. So here we go. So, I guess it's called reading the market. And clearly this is what the market is saying to us, is that we're not buying a home. We don't want to buy a home right now. It's the bad time for many reasons. And that's going to affect the housing market, all the way through. So when we take a look at what goes on here, this is the sort of six, components they review. Good time, bad time to buy. Obviously, people don't think it's a good time to buy. Good, bad time to sell. People think it's, people are decreasing from saying it's a good time to sell right now. Home price expectations, basically the percentage of respondents who say home prices will go up in the next 12 months decreased from 48 to 44%, while the percentage of those who say home prices will go down increased from 20 to 25%. So people are already saying, hey, we see the market changing here. We're going to wait it out. Mortgage rate expectations, mortgage rates going up increased from 69% to 73%. Job loss concerns, the percentage of respondents who say they are not concerned about losing their job in the next 12 months decreased from 86% to 84%, which is still, 84% is still pretty high, which goes to show that the economy, these are people who are concerned about losing their job. So as much as we have apparently low unemployment again, and we have all these job openings, why are people concerned about losing their jobs? That doesn't kind of make sense. So there's a lot of financial disconnects and statistical disconnects going on with respect to the market, housing market, the economy, etc. Household income, the percentage of respondents say their household income is significantly higher than it was last 12 months, decreased as well. So really, inflation, stock market crash. Today, crypto's, dialing it in and having a hard time as well. So we're kind of all over the place with respect to what's going on here in the market. So as I mentioned, though, this is a recipe for housing correction, housing crash, because we have multiple components now. Before, it just was, hey, we've got COVID and who knows how it's going to play out. And then we have some foreclosures, but we have forbearance and delinquencies. And that's the one thing I want to mention too. There's a lot of articles out now saying delinquencies are down. So delinquencies are down, but foreclosure activity's up. So to me, that doesn't kind of make sense. Where the delinquencies are down, because what's happening is that people who are moving out of forbearance plans probably are being not counted in the delinquent side of things. So, but realize though, if you're not jumping on if after forbearance, if you're not taking or going into a loan mod or some sort of restructuring, then you're delinquent. I think there's a lag on reporting. That's why, with all the bad news, I think there's a lag in reporting things correctly or whatever. That's the reason why we're seeing that disconnect there. So again, statistics are hard to figure out. But listen, everything we're talking about here points negative, negative, negative. People are expecting a crash correction now. And this is kind of the whole thing too. Like, it's not necessarily social media, but it's the social vibe. Like, we will wish it, we expect it. It's almost like we will it to happen. And I think that's what we're doing now, is we're going to will this market to change and correct. It'll correct for sure, certain percentage points. How, if, when, high, and how it will crash is a whole different ball game. That's coming up, though. Okay, remember, going from now maybe 10-15% correction to the 2018-19 kind of values, then crashing to the 2012 type values. That's sort of what has been discussed in the marketplace here. So very interesting. Now, for those of you who appreciate the information I provided, the data, and love to talk about housing, if you could help my channel grow and smash that subscribe button, I'd really appreciate that. And for my subscribers, if you could do me a favor and please double check that you're subscribed, or put those notification little features on, because I look at the numbers. I lose subscribers all the time, and I know a lot of you don't have your stuff turned on. You're missing my videos. All right. Thank you very much. I appreciate everyone's patronage and views. So this is interesting, because this to me was another feet on the street thing, but it was more of a newsworthy article. So hospital workers are fleeing high housing costs. Where are they moving? Well, as hospitals battle workforce shortages, part of the struggles come from workers leaving their jobs at hospitals for various reasons. Some have left because of the emotional exhaustion, while others have retired early. Clearly, the past couple of years have not been easy for hospital workers. I can imagine, especially in some locations across the country, it was probably out of control chaos at best. But there's another factor for contributing to the shortages: housing costs. So for some hospitals, the issue has become so prevalent they are building employee housing, kind of like student housing, right? I mean, student housing is a great investment now, putting housing up around campuses and stuff. And now it looks like the hospitals are doing the same thing. Think about the hospital. It's almost like its own campus. A lot of hospitals are on campuses, right? They're associated with universities and colleges, so it seems to make sense. But although the nation's mover rate has been decreasing for several years, almost half of all movers in 2021 cited housing-related reasons for moving, according to a U.S. Census Bureau report released in March. Now, this is interesting, because where are people moving to? Well, the top 10 moving destinations for 2021, moving truck rental company Penske examined one-way consumer truck rental reservations made through the company's website. They got 2,500 truck rental locations. So we see it from Penske. We see it from Atlas, Van Line sometimes, because they're the moving trucks. We also see it from U-Haul, so I guess it's just another data to look at. So basically, the top 10 moving destinations for 2021, according to the Penske list, and again, this is one-way truck rental. So I'm leaving City A, going to City B, and leaving my truck there. I'm not coming back, okay? Houston, number 1. Vegas, number 2. Phoenix, number 3. Charlotte, North Carolina, number 4. Denver, number 5. San Antonio, number 6. Dallas, number 7. Orlando, Florida, number 8. Austin, Texas, number 9. And Chicago, number 10. I'm actually surprised that Chicago is actually seeing a net going to, as opposed to people leaving Chicago in the state, because for years now, Illinois has been one of the most, I guess you could say, what's what I'm looking for. Like they're losing more people than they're gaining on a high, and people are just leaving because of many issues. A lot of it is just the high cost of living and high taxes. Again, but there's more issues. But again, this is for 2021. So we're only, what, 4 and a bit months into 2022. I know those top 10 will probably change a little bit with respect to, how will they change as far as locations and where they rank, probably. But what we really see here is um, we see movement to the southern states or the warmer states. I mean, really, Denver would be the one place I would say is not particularly warm, but I've never been there. But it's very nice from what I understand. And really, Chicago. I mean, Chicago, clearly it's in the north and upper Midwest, so there you go. But the point, everything is warmer or in the south. And there's probably, commuting times, there's probably cost of living, there is probably housing. Obviously, housing cost is number one, but just lifestyle. So all these places are fun, nicer, bigger cities type of thing. So that's why I assume people are moving there. But anyway, that's the scoop with respect to hospital workers. It's just interesting to get, again, another demographic of the American public and what's going on. So that's kind of it for today. Again, I forgot to update that. May 12th will be our first call, our second call, but our first real training call. Again, I'm talking about distressed property stuff, things that I've talked about generally over the past few years. I'm going to get into it very detailed, and you're going to see why there are opportunities. I actually just today, every so often, I update, the sort of peg count of foreclosure auctions in counties in Florida that I look at. And some counties are sort of maintaining, and some counties are growing. Right, it just depends on what's happening. But the point, though, is that they're there, and we're seeing more and more. And foreclosure filings are up. So there's an article. I mean, I think I talked about it last video, but I mean the foreclosure numbers. 132%. Activity year over year, whatever. So compared to a year when we didn't have much activity, yeah, the percentage numbers are going to look big. I get it, but in the end, it's about what's going on in the marketplace and where the opportunities are. So I look at it, guys. I call it follow the foreclosures, and the foreclosure fortunes will come to you. All right. Anyway, that's a scoop for today. So hit me up. I have a lot of people that I didn't get to just because of sheer volume, guys. I was working hard last week trying to get people on, answering a lot of questions, taking a lot of calls, and there are people that I just simply I just couldn't connect with for various reasons. So now's your chance. I got 2 or 3 days before Thursday that we can actually go back at this and get people on, and then we'll go from there. All right. So how do you get a hold of me? Just go to randy@luxuryshortsales.com. Please, when you send me an email, put in your phone number so I can call you and not have to play the email game back and forth to get your number. All right. Anyway, guys, once again, I appreciate the views, the likes, and the comments. Please share the video with your family and friends. If you're a subscriber, please, if you're not a subscriber, please subscribe. And we look forward to speaking with you towards the end of the week. Take care.